Hi, this is Michael King. We're going to talk again about other risks in bonds. This is going to be sections 6.3, 6.4, and section 18.5 from Booth, Cleary, and Rikita. So here's just a table that summarizes some of the common risks that you will find in bonds. We've talked extensively about the price yield sensitivity, and that is known as interest rate risk. But when considering cash flows that we receive from a bond, we have to keep in mind that we're getting what are called nominal cash flows, which means money that is not adjusted for the impact of changes in prices. When you have inflation, which means rising prices over time, the purchasing power of the money that you will get back at maturity will be worth less. And so inflation itself is a risk. Think about your yield to maturity as being made up of two components: the real rate of return on the bond plus some expected inflation. And we only observe this so-called nominal rate, the combination of both. Another risk is the risk called credit risk that the borrower will not be able to pay. Now, this happens for both sovereigns as well as for businesses. Currency risk is when you have a bond issued in a foreign currency, so a Canadian borrower issuing in the US in US dollars. There would be a risk for you, the investor holding that bond, from changes in the Canadian dollar US dollar exchange rate. Another factor that will affect bond prices are interest rates, and we often talk about shifts in the yield curve, where the yield curve, which is also called the term structure of interest rates, is simply a graphical illustration of the interest rates available on bonds with different maturities. So here I'm just plotting three yields for Government of Canada bonds with maturities of 1, 5, and 10 years. And as you can see, typically the yields are increasing as you get longer maturity, and drawing a line through those or interpolating, you would see that the yield curve is upward sloping. Looking at the US yield curve, yields are very low from 1 month out to about 1 year, and then they begin to rise out through 3, 5, 7, 10, and out to 30 years. Keep in mind that the US government auctions bonds on a regular basis, and so the most recently auctioned bonds are called on the run, and older bonds that were issued, for example, the 10-year bond issued 6 months ago would be called off the run. So there's at least three theories that will explain the shape of the yield curve, and there's evidence actually to support all three of them. So the first is something called liquidity preference, which is that investors don't like to take risk, and so they prefer short-term, more liquid debt instruments. In order for them to buy longer-term instruments, you're going to have to offer them a higher rate of interest, and this explains an upward sloping yield curve. Another complementary view is the expectations theory, and it's the view that the yield curve reflects what people's expectations are about future rates. With an upward sloping yield curve, people are expecting that rates are going to go up over time, and therefore longer maturities have higher rates. You do see sometimes a downward sloping yield curve where short-term rates have a higher yield than long-term rates. That might occur at a change in the business cycle where the central bank, which has control over a very short-term policy rate, has pushed that rate up, and it is leading people to anticipate that market rates will go down over time. A third theory is called the market segmentation theory, and it's basically an idea that there's supply and demand dynamics in different parts of the yield curve, which affect the interest rates offered in different parts of the yield curve. And that's sometimes called the preferred habitat, because some investors, such as pension funds, prefer to buy long maturity bonds because of their liabilities, whereas others, such as banks or money market funds or mutual funds, may want to buy bonds that have short maturities. So we did mention inflation risk a moment ago, which is changes in purchasing power, and that's going to affect the yield on a bond. When inflation goes up, your money that you get back, particularly the face value in the future, is going to buy you less. We talk about expected inflation because we don't actually observe price changes until they happen, but the bond yields will be reflecting some sort of aggregate market expectation for that inflation. And there's kind of a simple way to show this and a more sophisticated way. The simple way is basically to say that the nominal rate, or the rate that we observe on any given day, is actually made up of an unobservable real rate and expected inflation. So it's the sum of those two. More precisely, what this means is that the nominal rate is actually 1 plus the real rate times 1 plus the expected inflation rate minus 1. That takes into account that inflation is compounding. A final risk I want to talk about is credit risk, which is the risk of not being able to make payments on interest or principal when they are due. Credit risk is typically associated with corporate bonds. We tend to think of the pricing of a corporate bond as incorporating this default premium, and where it shows up is in the yield to maturity. So you would typically have a yield to maturity made up of two components. These are both nominal. The risk-free rate, which is the rate at which the government is able to borrow, plus an additional premium or spread for the corporate borrower over and above that risk-free rate. Now, when we say risk-free rate, we know that the rate is not exactly free, but if you look at, say, the United States issuing in US dollars, it does represent the lowest risk benchmark because the US government can always repay its debt by either printing money or using taxes, raising taxes in order to pay off the debt. So credit risk is a failure to pay interest or principal, and that leads to what's called an event of default, but it may or may not lead to bankruptcy because many investors would rather avoid going into bankruptcy and having to liquidate the assets of the firm in order to recover their investment. So they'll often trigger an event of default, which will lead to a renegotiation. How do you understand what that risk is? Well, there's three agencies at least that are involved with providing ratings or credit scores. Credit rating agencies, they assign letter ratings to issuers based on how likely the probability of repayment is. AAA is most likely, and as the letters get lower, such as Baa1 or BBB+, for example, is more likely to default. There is going to be a big distinction between what are called investment grade ratings and non-investment grade ratings, where investment grade ratings are AAA through BBB and non-investment grade ratings are BB and below. Some investors are not even allowed to buy bonds that are below investment grade. So here's an example of the rating scales from Moody's, S&P, and Fitch. You can see that they all start at AAA and they go down to either single C or single D. But notice that S&P and Fitch are using exactly the same notation and Moody's is different. So as you can see, Moody's uses uppercase and lowercase, and it uses the modifiers 1, 2, and 3 to signify strong and weak within a rating category. So a Baa1 from Moody's is equivalent to BBB+ under both S&P and Fitch. Now this table is split up into investment grade and non-investment grade. So non-investment grade are bonds that have a rating of BB and lower, so technically Ba1 or BB+ and lower, all the way to default. And as they got the nickname junk bonds in the 1980s because of Michael Milken, that was the term, was developed as he was leading a lot of leveraged buyouts, but then salespeople rebranded them as high yield bonds. These credit spreads are tracked very closely. They're used for pricing bond issues every single day for corporates with different ratings. In the chart on the right, if you were to plot the credit spread in basis points, where 1 basis point is 0.01% or 100 basis points is equal to 1%, you can see by plotting in basis points, bonds that have a lower credit rating, such as BBB, have to pay a higher premium or a larger credit spread over bonds that are rated AAA. So the AAA bonds are low. They're around 50 basis points in this diagram, and you can see they're in red. Whereas the gold, the BBB, are up more around 200 to 300 basis points. So the way you would express this is you'd say the yield to maturity is the sum of a risk-free rate plus this credit spread or this credit premium. So for example, if the risk-free rate in a given maturity was 2.5%, and the company's bonds were trading at a spread of 150 basis points over the risk-free rate, then that means that the yield to maturity on the company's bonds are 4%, 2.5 plus 1.5.